In this video, we're looking at the 2010 costing question. So as you can see here, part A was about stock control, so Fifo, stock valuation, and we'll just get straight into it. So Rose Limited is a retail store that buys and sells one product. The following information relates to the purchases and sales of the firm for the year 2009. So you can see here, there is three periods of the year, 4 months each, okay, and you can see that they have different purchases and different sales, and that the amounts they're all different amounts as well, okay. So you can see then it says on the 1st of 1st 2009 there was an opening stock of 4,000 units at €4 each. So you are required to, part 1, calculate the value of closing stock using the first in, first out method. So that is basically just selling the goods that you have purchased first. So when you buy it, you sell that one straight away, okay? And then you purchase goods after that, and then you'd sell them later when the other ones are sold first. Okay, in part 2, prepare a trading account for the year ending 31st the 12th, 2009. So calculate the value of closing stock. So we want to know like a euro amount there, euro value, okay, of the closing stock. So what we need to do first is we would need to know how many units of closing stock are there, okay? So how many units of closing stock do they have? So if you can think about it, at the start of the year, they had opening stock 4,000 units. Then what they did during the year, they purchased loads of units, and then they sold loads of units. So we have to see what they have left at the end of that. So we've got opening stock there, 4,000 units. We're going to add all of the purchases, so 3,000, 2,200 and 1,500, which would be €6,700. And then we take away all of the sales, so 900 and 1,100 and 1,200, 1,200, 1,300, 1,200. So we minus €6,900, 6,900 units. So what we're left with then, we are left with 3,800 units of stock at the end of the year. Now we're told to value it using first in, first out method. So as we said before, the stock that you buy first, you'd sell that first. So therefore, you're going to have the stock that was bought last, you're going to have that still in the warehouse, right? So this first 1,500, we're going to value that at €7 each. So that is €10,500. Then that leaves us with 2,300 units of stock still left. And that's going to mean we're going to have all of these 2,200 at €6 each. And that adds up to 13,200. And then we have 100 units each left, which will be some of the ones that were bought for €4. And that is equal to €400. When we add all of those up together, we get that the closing stock is therefore €24,100. So that is the value of the closing stock using the first in, first out method. So €24,100. So that is part 1. Part 2 is then asking us to prepare a trading account for the year ending 31st of the 12th, 2009. So a trading account is sales less cost of sales. Opening stock plus purchases minus closing stock, that's your cost of goods. You take that away from your sales, that's your gross profit. So you're going to be on the calculator a hell of a lot now, okay? What you need to do is you need to look at your sales. You need to multiply 900 by 9 and then add that to 1,100 by 10, add that to 1,200 by 10, add that to 1,200 by 11, add that to 1,300 by 12, add that to 1,200 multiplied by 13, and you are getting sales €75,500. You're going to start your less cost of sales then. So you've got opening stock. So there's opening stock there, 4,000 units at €4 each. That's €16,000. Then you're going to add your purchases. So your purchases are up here. You're going to multiply 3,000 by 4, add that to 2,200 by 6, and add that to 1,500 by 7. And you get €35,700 is your purchases. And then you take away the answer that you got in part 1. which is your closing stock, €24,100. That gives you a cost of sales then, so 16,000 plus 35,700 minus 24,100 gives you €27,600, allowing us to have a gross profit of €47,900. So that is part 2 done, and we've got all of part A done there as well. So moving on to see what they have for us in part B, it's product costing. So it says Dwyer Limited is a small company with 3 departments. The following are the company's budgeted costs for the coming year. So we've got departments A, B and C. In those departments we've got variable costs, we've got fixed costs, and we've got wage rates per hour. General administration overhead absorption rate per hour is budgeted to be €5.50. The following are the specifications for a quotation for job number 209. Material costs 7350. Labour hours required in each department. You've got Department A, B and C. You've got 95 hours in Department A, 185 hours in Department B and 60 hours in Department C. You are required to calculate the selling price of job number 209 if the profit is set at 20% of the selling price. Okay, so we just need to tot up all the costs, right? So you've got variable costs, you've got fixed costs, you've got wages, and you have admin costs. You also have material costs here. So job number 209, we're told how many hours are used in each department. Okay, so we're going to use those hours and multiply them by the various costs, and then we'll calculate the selling price if the profit is budgeted to be 20% of the selling price. Okay, so variable costs, we're just going to multiply the 95 by 15, the 185 by 17 and the 60 by 22. Okay, and we'll get our answers there: 1425, 3145 and 1320, and a total there variable cost of 5890. Then we're going to look at the fixed costs, and so the fixed costs, we've got 95 by 6, 185 by 5 and 60 by 4, and we get €570, €925, €240, and that totals 1735. Then we've got the hours and we multiply them by the wage rate per hour. So we've got 95 by 13, 185 by 15, 60 by 10, and so we add all them up and we get 4610. Then the admin overhead, so we're told that it's $5.50 per hour, and we know the amount of hours that we have. So we've 95, 185 and 60. That is 340 hours at €5.50 per hour. So that tots up to 1870. Then we've got direct materials. So I have this covered here, but it was 7350. So we add that there as well. What we do then is we just tot up all of the costs. So 5890 plus 1735 plus 4610 plus 1870 plus 7350 gives me a selling price of a cost price of 21,455, which we know is 80% of the selling price, okay, because profit is 20% of the selling price. So for us to find the profit then, 21,455 divided by 80 multiplied by 20 gives me a profit of 5363.75. Then when we add that together then, we get a selling price of 26,818.75 cents. So that is the selling price there. So that's part B done, the product costing. Last part of this question then is under and over absorption of costs. So it says here, the information set out below refers to the budgeted and actual costs of Hennigan Manufacturing Limited. So here you can see the budgeted costs. These are the costs that the management accountant came up with. Okay, so they have their Excel spreadsheets, they're recording costs for don't know how long, getting prices, etc., putting it all together, and this is what they think the departments can be run at. Okay, so they think Department X, there's 8,000 labour hours, there would be 35,000 machine hours, and that the total cost of running that, so the total overhead's 140,000. Then they think Department Y, 45,000 labour hours, 10,000 machine hours, 36,000 total overhead. And then Department Z, 20,000 labour hours, 40,000 total overheads. Okay, now we're just going to look at part one first, because part one is asking us calculate departmental overhead absorption rates for departments X, Y and Z. So what they want is they want us to break down these huge figures here, the total overheads, into a per hour basis. Okay, how are we going to do that? We're going to use the most dominant activity. Okay, so the most dominant activity. So 140 divided by 35, 36,000 divided by 45, 40,000 divided by 20, and that will give us our overhead absorption rates. Okay, so we're looking for the most dominant activity in both them. So Department X, most dominant activity is our machine hours. Department Y, most dominant activity is our labour hours. Department Z, most dominant activity, labour. Okay, what we're going to do, we're going to take the figures, the budgeted figures, and we're going to divide them by the amount of hours in the most dominant activity, and that is our answer for part one. So part one, all you're doing is dividing one figure by another. Okay, so you've got that in Department X, you've got that it is €4 per machine hour. In Department Y, you've got that it is 80 cents per labour hour. And in Department Z, you've got that it is €2 per labour hour. So that is the answer for part A. Okay, now next what you're asked to do, you're asked to show the under or over absorption by department and in total for the period and explain what these figures mean. So what you're going to be doing here in this part of the question is you're going to be taking the management accountant's budgeted absorption rate, okay, so the amount that they thought, and you're going to be multiplying them by the actual hours in the most dominant activity. So how much would the management accountant think that the cost should be based on the actual hours? So you're going to take the actual hours, multiply it by the rate that the management accountant came up with. So 40,000 multiplied by €4 is 160. Now if you compare that 160 is what the management accountant thinks, what it thinks it could come up, it should cost, but the actual hours, so the production manager actually got it in at 155. So that's really good. Okay, the next one is 37,000 hours. Okay, multiply that by the rate that the management accountant came up with, and that is 29,600 hours, or sorry, €29,600. That's what the management accountant thinks it should have cost, but it actually cost 30,000. So that is not good, because that's actually €400 more than what the management accountant thinks it should have cost. And then Department Z, 25,000 hours multiplied by the management accountant's rate of €2 is €50,000. That's what the management accountant thinks it should have come up at, but the production manager's actual figure was €45,000. So that is actually really, really, really good, okay, because they came in €5,000 cheaper. So we're asked to explain what all these figures mean, okay? So what we'll say in Department X, the costs incurred were 5,000 less than expected or budgeted, and therefore profits are 5,000 greater than expected. In Department Y, the costs incurred were 400 more than expected or budgeted, and therefore profits are 400 less than expected. And Department Z, the costs incurred were 5,000 less than expected or budgeted, and therefore profits are 5,000 greater than expected. And in total, overall, the costs incurred were 9,600 less than expected or budgeted, and therefore profits are 9,600 greater than expected. So all we're doing in this question is we are comparing the actual costs with what the management accountant thinks it should have cost based on the actual hours. And so the impact of that is, you know, is the profit going to be more or less? Were the costs more or less? And so you just have to write out those sentences, okay, to explain what all of the figures mean. And so that is under over absorption, where we are comparing budgeted with actual results. Okay, so that is the 2010 cost in question complete.